welcome to our Market Pulse call. Thank you for joining us today. It's quite timely given this little bit of a pullback that we're seeing today. So with some commentary on what we're seeing in the market here today and our general outlook, I'll pass it over to Mark. Mark, what's our consensus here?
Thanks, Shawn. I'll give a bit of a macro global update. It's our view that the first phase of the COVID global downturn is coming to an end, with gross domestic products collapsing in the second quarter of the year around the world. But with the aggressive and quickly implemented monetary and fiscal policies from central banks and governments around the world, we should be moving into the second phase in the third quarter, which is stabilization. Already, May's brought some relief, with consumer and business sentiments surveys ticking higher. Also, the economic surprises indexes, an index which shows how economic data are progressing relative to the consensus forecast of market economists, seems to have bottomed out in most economic regions. The surprisingly swift and strong recovery in risk assets, along with the reopening of several economies globally, should further bolster sentiment going into the summer. Considering the various time lags between quantitative easing, policy rate cuts, and market-based reflation with the global economy, the calendar still points to the fourth quarter for what we call the third and final phase, economic reacceleration. As a side note, reflation is a policy that is enacted after a period of economic slowdown or contraction, with the goal being to expand output and stimulate spending and curb the effects of deflation, obviously what we are seeing right now. It is in the third phase that discussions on the economy move from the direction of growth to the quantity of growth. This will be difficult to formulate now, since the outcome depends on so many unknowns. Key variables such as whether backstops to individuals, corporations, and financial markets will be extended in the fall, as well as how will the financial markets perform now that the new Treasury bond issues required to finance the US budget deficit are exceeding the planned purchases by the Fed under QE5. Recently, there have been Fed discussions about a yield curve control, which essentially means the Fed targets a particular yield curve, yield level, and buys enough bonds to keep the rate from rising above that target level. This may be required in the future should an oversupply of bonds push bond yields higher, which we believe the Fed will not allow. Lower rates for longer is obviously the path to recovery. Obviously, there are many variables and uncertainties to consider, but we are optimistic in the global recovery over the next 12 to 24 months. Shawn?
Yeah, and in terms of maybe our asset mix, Erik, I'll bring you in here. How are we positioning ourselves, and what do we make of this notion that equities might actually overshoot here a little bit to the upside?
Yeah, thanks, Shawn. I mean, as we can all see here, the tug of war is continued, and that's the tug of war between the coronavirus and the Fed. And we do remain cautiously optimistic, although we believe that stock selection is going to be key going forward. In our May report, for those that read our monthly note, we listed 3 possible upside risks to equities, and first being the US mega cap growth bubble, which has been continuing to inflate. Second was that value stocks were slowly coming here up on the rebound. And the third note that we said was that we expected short sellers to scramble to cover these massive short positions on equity futures. And although the first 2 factors have played out the way that we thought that they would in the last 30 days, what hasn't played out is this massive short that continues to exist in the markets. It's been fueled. We felt that perhaps there'd be some added fuel to the fire with the covering of these shorts. And in fact, the US short sellers right now have been adding to their bearish bets, and they're as bearish as they were about 6 weeks ago when we were seeing market lows. So that said, with history as our guide, we believe that the markets are likely to overshoot over the next several months and into perhaps higher than even our year-end targets. Another thing that we're looking at otherwise is the important development that we're seeing between whether or not the US Treasuries are going to continue to dwarf the purchases by the Fed through their quantitative easing process. So I would say that they may very well overshoot, Shawn.
Yeah. We've got some questions that came in. Erik, you kind of touched on this, but maybe we'll get Mark's thoughts on this. Naturally, everyone's talking about this potential second wave of COVID coming in the fall. Well, obviously, that's still a few months away, and there's a lot of other factors going on right now. What are we thinking about the next 6 months, and how are we preparing the portfolio in the event that we do get maybe an increase of cases in the latter half of the year?
Yeah, that's certainly a big discussion point right now. I mean, perhaps even more prior to today, because today we are seeing a bit of a pullback. The market did seem like it was getting a little bit overheated, so this is probably healthy. But I wouldn't be surprised at all, based on the history of these things in the past, to see a second phase of COVID. But at the current time, the market seems to be content to digest COVID developments on a day-to-day basis. Who knows? I mean, with all the concerted efforts around the globe, there could be a vaccine or treatment by that time. And what if there's no second wave? So really to position a portfolio for that second wave, I don't really think it makes sense. It won't serve any of us very well, and we'll probably just miss out on further upside. And as all of our clients, all of our retired clients particularly know from our in-depth discussions, we always maintain holding 12 to 18 months of cash to cover any necessary expenditures over that time period, so we don't need to touch the portfolios when they may have some volatility. That all being said, we've taken advantage of the pullback to high grade a lot of our positions right now, so we'll be able to better withstand a period of volatility. What we believe is off the table is a re-shutting down of major economies, as you can see in the US, for example. They are not interested in shutting it down at all. Authorities throughout most of the world have made it abundantly clear that if a second wave does hit, they'll continue to maintain a degree of operational normalcy amongst businesses. And also, the amount of stimulus being injected into the market and the economy is truly unprecedented. None of us have seen this before. So we feel fiscal authorities acted swiftly and aggressively enough to ensure the economy did not tailspin into a depression-style era or depression-style scenario. And reserve banks as well have made it abundantly clear that there's no end in the actions they will take to ensure a properly functioning market and economy. So we're relatively optimistic, and I hope that answers that question.
Yeah, I would add that we were actually a little bit strategic this week, raising about another 3% of cash. So we're sitting at about 10% of cash today prior to this pullback. Erik, this one's for you. Looks at REITs, which traditionally they're a bond proxy investment, which means that they're supposed to be a little bit more defensive. They weren't that case. Obviously, in Q1 they struggled with the rest of the market. What are your thoughts on REITs, and what is their outlook?
For those of us that were around in 08, 09, REITs, albeit they are considered to be a place for income and a safer haven than equities. When you get a sell-off in the markets like we had with massive fear and panic, I think all asset classes sell off, and that would include REITs. There was some initial concern with respect to REITs that people wouldn't be able to pay their rent, and for a number of the REITs, that was the initial reason for the sell-off. But there were some government programs that came in very quickly and addressed that issue. So clearly there's a disconnect between what's in the REITs right now, which is real property, and the value that the market is putting on the REITs. We do think that, given the low financing costs and the wall of private capital, and I think, Shawn, you came out with a number of about $328 billion of dry powder for real estate investments. That should bring the real value of REITs, as we start seeing some transactions happen in the markets. It should narrow that gap. So we believe that property values will be supported, and particularly, I think, in the sectors of solid fundamentals, which would be, the industrial and pure multi side.
Yeah. Yeah, that 328 billion was just straight capital. Obviously, that can be bought on leverage, so the net effect of buying would just be even more compounded there. Mark, switching it over to you. Obviously, the markets have had a tremendous rally here the last 2 months. There's some talk of certain sectors being a little bit stretched, maybe tech, namely. But just as far as other sectors and companies that maybe haven't performed or partaken as much in the rally, where are we seeing value right now?
I think this is a very timely question. You know, over the last couple of weeks, prior to this week, we really started to see a shift from growth into value, and the banks and the industrials. Nearly all the areas of the market that generally outperform with expectations for an economic recovery spiked last week. So that's positive. Far outperform in the stay-at-home areas, like you just said, Shawn, that led to gains off the March 23rd low, like the technology stocks. In fact, there's a bank stock index called the KBW Bank Stock Index, which is ticker symbol BKX. It's a benchmark index for the banking sector in the US, and it had its best 2-day performance since April 2009, up just 15% in 2 days. So there's certainly some value to be had there. I mean, the rotation certainly slowed this week, but there continues to be tremendous performance gap between growth and value. I'd say the most important point for investors to remember is that although we have seen such a strong rally, it has been led, like you said, Shawn, mostly by growth. As of the end of May, many, if not most of the value stocks in the S&P were still substantially down. And as many of our clients know, I often use the Canadian banks as a good example of this. And I defer to Bank of Montreal just because it's an easy one. It's still down today, 30% from its high. So when people tell me, well, the market's returned to the same point, where are we going to find value right now? Well, you know, if you own Facebook, Amazon, Google, Netflix, Microsoft, you know, some of these names we do own, of course. But if that's all you owned, of course, you'd be flat for the year, maybe not down slightly as of today. But there's still substantial value out there. So I'm not fearful on finding good companies to invest in going forward.
Yeah, and for people that follow Tony Dwyer's work quite closely, you'll know he's quite bullish on the banks and tanks. Tanks obviously being the industrial name, so he sees a lot of value there, and we probably echo that sentiment. Erik, switching over to you. You're our FX man on the team. US dollar continues to be very, very topical with that 10% rally we saw in Q1. It's a full 10% retracement here in the last 2 months. It's not supposed to be that volatile, but let's once again get your thoughts on the US Canadian dollar.
This is the hardest. This is almost as hard as gold to figure out what the direction's going to be. Yeah, you know, I think that the US dollar, for the most part, it's kind of like an on-off switch. We've got when the markets are risk on, the dollar sells off, and when the markets are risk off, the dollar rallies. So, you know, case in point today, after having sort of 8 or 9 days in a row to the green in the markets, today we're having a pretty substantial sell-off, and the US dollar is up. So I would say that unfortunately yesterday the Fed basically pegged interest rates at or near zero. I think they went to potentially 2022, Shawn. So
yeah.
You know, that said, it's hard to be bullish the US dollar when the rates are at zero, and in Canada, you know, that said, you know, there could be some Canada specific shock that like a housing crash, or perhaps the Bank of Canada decides to increase their QE program and make it sort of more closely to the rival in the US. You know, that would be a bullish note for the US dollar to appreciate, but right now I think that and that said, I don't think there's going to be a huge swing in the dollar, because, you know, that massive risk off trade that happened sort of March 23rd, I don't foresee that, you know, as Mark has outlined, see that coming up, you know, over the next couple of quarters. So we at this point are bullish CAD to US, but I mean things change daily, as we've seen today.
Yeah, I would just add that the amount of stimulus that the U.S. Fed has put out. Granted, it's obviously a bigger economy, but relative to every other country out there, they've far outspent anyone else proportionally. So there's a lot of U.S. dollar and a lot of cheap U.S. dollar hitting the global markets right now.
The only note on that, Shawn, would be, and we talked about this the other day, would be that we don't tend to try to hedge out positions in the portfolio because it is too hard for us to judge which direction. So we own U.S. equities, we own Canadian equities, we own each of them in their currencies, and we don't worry too much about the currency risk because, you know, we live in Canada. That's really the currency that we're most concerned about.
Yeah, it's noise that we can't really control. Perfect. Well, that was all the questions we had. So I guess that'll do it for this month's Market Pulse call. Appreciate everyone jumping on. And Erik or Mark, you guys have any closing remarks you want to say?
Thanks for joining us, and look forward to the next call. And I think I don't know, do you know what we've got next week planned?
Yeah, sorry. So we've got Michael Hughes, who's the Global Portfolio Manager for the BMO Concentrated Global Equity Fund. That's a fund that is in our income growth and our fund of funds portfolio. It's a core holding that we've had for about 2 years. It's done extraordinarily well. So it's going to be great to have him on and get his thoughts on the market.
Awesome. Thanks, Shawn.
Great.
Erik.
Thanks, Shawn. Thanks,
Cheers, guys.
Mark.